Hello and welcome back. This is your host Harshit Sinha after a long time with an interesting series based on ESG investments in India. India has emerged as a promising destination for sustainable investing with a growing focus on environmental, social, and governance factors driving investment decisions. The country's expanding economy, rapidly evolving regulatory landscape, and increasing investors' awareness present in significant opportunities for ESG aligned capital deployment. In recent years, India has seen a significant uptick in ESG focused investment funds and strategies. This growth is driven by several factors, including heightened awareness of climate change, social inequalities, and corporate governance issues. The Indian government commitment to achieving ambitious climate goals such as net zero emission by 270 has further catalyzed interest in ESG investments. Thus, many Indians companies are now proactively improving their ESG performance to attract investment and meet evolving regulatory requirements. Sectors such as renewable energy, clean technology, and sustainable agriculture are particularly benefiting from this trend. However, challenges remain in Indian ESG investment landscape. Despite these hurdles, the future of ESG investment in India looking promising. As awareness grows and regulatory frameworks evolve, ESG considerations are likely to become increasingly integral to investment decisions in the country. This shift has the potential to drive positive change across industries, promoting sustainable development and responsible business practice throughout India's rapidly growing economy. Thus, addressing key challenges and fostering collaborative initiatives will be crucial in unlocking the full potential of the sustainable investing in the country. This slide discusses the United Nations Principles for Responsible Investment. The UNPRI had a significant impact on the investment industry since its launch in 2006. It has helped to raise awareness to the importance of ESG issues and has encouraged investors to integrate these factors into their investment process. In 2021, the United Nations Principle for Responsible Investment, that is UNPRI, are a set of six principles designed to guide investors in incorporating environmental, social, and governance factors into their investment decision and ownership practice. These principles were developed by an international group of institutional investors with a mission for an economically efficient, sustainable global financial system is a necessity for long-term value creation. Such a system will reward long-term responsible investment and benefit the environment and society as whole, reflecting the increasing relevance of ESG issue to investment practice. Here, a detailed overview of each principle are going to be described. Principle 1. Incorporate ESG issue into investment analysis and decision-making process. This principle emphasizes the importance of integrating ESG factors into the investment analysis and decision-making process. Investors are encouraged to consider how ESG issue might impact the financial performance of their investments. This can involve conducting a thorough ESG research using ESG data and analytics and incorporating these insights into investment strategy. By doing so, investors can identify potential risks and opportunities that may not be apparent through traditional financial analysis alone. Principle 2. Be active owner and incorporate ESG issue into ownership policies and practice. Active ownership involves using the right and position of ownership to influence the behavior of these investee companies. This principle encourages investors to engage with companies on ESG issues, vote on shareholder resolutions, and participate in collaborative initiatives. By being active owner, investors can drive positive changes in corporate behavior, improve ESG performance, and ultimately enhance the long-term value creation. Principle 3 seeks appropriate disclosure on ESG issue by entities in which investments are made. Transparency is crucial for responsible investment. These principles call for investors to seek adequate disclosure on ESG issues from the companies in which they invest. This can include requesting information on companies' ESG policies, practice, and performance. Enhanced disclosure allows investors to make more informed decisions and hold companies accountable to their ESG impact. Next is Principle 4 that promotes acceptance and implementation of the principles within the investment industries. This principle focuses on promoting the widespread adoption of the UNPRI within the investment community. Investors are encouraged to advocate for responsible investment practice and share their experience and best practices with peers. By fostering a culture of responsible investment, the entire industries can move towards more sustainable and ethical investment practice. Next is related to work together to enhance our effectiveness in implementing the principles. The collaboration is the key to achieving the goal of the UNPRI. This principle encourages the investors to work together to enhance their effectiveness in implementing the principles. This can involve participating in collaborative engagement, sharing research and insights, and supporting initiatives that promote responsible investment. By working together, investors can amplify their impact and drive systematic changes in the financial market. The last principle says reports on activities and progress towards implementing the principles. Accountability and transparency are essential for credibility of the UNPRI. This principle calls for investors to report on their activities and progress in implementing the principles. Regular reporting helps to demonstrate commitment, tracks progress, and identify areas for improvement. It also provides stakeholders with valuable information on how investors are addressing ESG issues. Overall, while the UNPRI has made sustainable progress, challenges remain. One of the main challenges is the lack of standardization of ESG data and matrices, which can make it difficult for investors to assess and compare ESG performance. Additionally, there is a need for a greater alignment between the ESG consideration and the financial performance to demonstrate the value of responsible investment. Looking ahead, the UNPRI aims to continue promoting responsible investment practices and addressing these challenges. This includes working together, greater standardization of ESG data, enhancing collaboration among the investors, and advocating for policies that support sustainable and responsible investment. This slide discusses the PRI responses to SEBI on BRSR scope disclosure under BRSR. Owing to my previous set of presentation on sustainability reporting, we all know that how business responsible reporting was transformed to business responsibility sustainable report. Here we are highlighting that PRI gave responses to SEBI's BRSR format. The PRI's key recommendation to SEBI on the updates of BRSR are: the BRSR disclosure requirement should lead to data that is consistent, comparable, and reliable. In this regard, PRI recommends aligning the BRSR with a goal reporting framework like the Task Force on the Climate Related Finance Disclosure, that is TCFD, on a voluntary basis to start with and making it mandatory over a reasonable, clearly defined time framework. Besides, BRSR also include guidance on data assurance. The next is SEBI should also contribute to the international dialogue on ESG reporting, harmonizing and standardizing, which is currently underway. PRI recommend that SEBI works with other national and multilateral reporting stakeholders to create a global standardized and comparable corporate ESG reporting framework, including standardized ESG indicator and underlying methodologies. Once such an international standard is defined, SEBI should align its reporting requirement with the internationally agreed reporting framework and matrices. Next is continuing, it also suggests that the SEBI could consider a sustainable taxonomy consistent with the efforts underway in Europe, Canada, and South Africa, and continue to contribute to global efforts to align sustainable finance activity through the IPSF. Further, the BRSR should include questions that encourages company to disclose forward-looking target that is dated and quantified, and will allow for tracking progress not only at the company and sector level but also in the broader context of India's environment and social goals. Next is PRI also advocate the BRSR should encourage company to disclose not only how ESG issues have impacted companies' operations, that is either positive or negative, but also the impact of the company operations on the environment and society. And the last is the PRI suggests that the BRSR should require company to disclose all material issues and all high-risk location of the plant's operation as opposed to only the top 3 as are currently prescribed. Especially manufacturing companies and conglomerates should report all relevant data points that can be material for investment analysis. Now we shall discuss the scope disclosure under the BRSR. So whatever PRI have suggested, already BRSR have included those points. Further now, the PRI welcomes the enhanced scope of the disclosure as indicated by the proposed renaming the existing Business Responsibility Report, that is BRR, to the Business Responsibility and Sustainability Report, that is BRSR. It also welcomes the transformative role the BRR has played over the years to develop sustainable disclosure on Indian companies. The PRI welcomes in particular the proposed BRSR content as well as the formats of disclosure, including the light version for smaller companies. The integration of BRSR with the MCA 21 portal, provided there is no significant duplication of reporting efforts for the companies. The intention to develop a Business Responsibility Sustainability Index for ensuring better quality reporting and comparability between the companies. ESG risk and opportunities. ESG factors likely to impact the financial condition or operating performance of an entity, that is financial materiality. Next is sustainability performance. How an entity operations and products impact either positive or negative stakeholders and the environment. And the last is related to social goals and planetary threshold, that is nationally, regionally or internationally recognized environment and social target norms and responsible within which the entity operates from the sustainability perspective. Well, this slide discusses about the reasons for the growth of ESG investments. Now, since we have incorporated PRI in our ESG, let us see what the reasons are the influencing the growth of ESG investment in India, especially after 2022. The first is related to the regulatory scenario. The first reason is rising awareness and adoption. Over the past few years, there has been a notable increase in awareness and adoption of ESG principles among the Indian investors. According to the report of Financial Express, over 64% of investors in India are expected to increase their exposure to sustainable fund in this year. The second is related to government commitment. India pledged to achieve net zero emission by 2070 necessitates the substantial capital expenditure estimated at 8 to 10 trillion over the next 5 decades and inclusion of UN Sustainable Development Goals. These global goals are served as a benchmark for measurement companies' attractiveness and capital raising capacity. The next is robust policies. India has implemented comprehensive ESG-focused policies such as mandatory business responsibility and sustainability reporting for a larger corporation. Next is related to the corporate initiatives. Many Indian companies are integrating ESG factors into their business strategy. This shift is driven by the need to meet the regulatory requirements, attract the ESG-focused investors, and enhance their corporate reputation. The next factor is investors' demand. It is related to the institutional investors. Leading Indian and international institutional investors are actively integrating ESG criteria into their investment decision-making process. Next is related to the retail investors. Retail investors in India are increasingly seeking out ESG-focused mutual funds and investment products driven by a growing awareness of sustainable investing. Next is related to the global influence. India's ESG investment landscape is being shaped by global trend as international investors seek exposure to the country's rapidly evolving sustainable finance ecosystem. Next factor is related to the sectoral opportunities. First is related to the priorities to renewable energy. The renewable energy sector, particularly solar and the wind power, offers significant opportunities for ESG-focused investment in India. The next is related to promote sustainable infrastructure. Investment in green building, sustainable transportation, and smart city development are driving ESG-aligned capital deployment. The next is related to strengthening the sustainable agriculture. The agriculture sector in India is witnessing a shift towards sustainable farming practice, creating avenue for ESG-conscious investments. And the next reason is rising circular economy. Initiatives aimed at the waste management, recycling, and the development of the circular economy are attracting ESG-oriented investors. The next factor is related to the collaborative initiative. This is related to the partnership. Collaborative between the government, regulators, and the private sector is crucial for driving ESG integration in India. Next is related to the capacity building. Initiatives to educate and train companies, investors, and public on ESG best practices are gaining momentum. Next is disclosure standard. Developing robust and standardized ESG disclosures framework can enhance transparency and investor confidence. The next is related to sustainability reporting. The adoption of mandatory sustainability reporting requirement is driven ESG integration across Indian businesses, integration ESG factors in credit rating. That is, the credit rating agency in India are increasingly incorporating ESG factor into their rating methodologies. For instance, CRISIL has launched ESG score for companies in India. The next factor is related to the investment strategies. First is related to thematic investing. The investors are targeting specific ESG-aligned themes such as clean energy, sustainable infrastructure, and circular economy. The next is related to the ESG integration. Fund managers are incorporating ESG factors into their investment analysis and decision-making process. The use of technology in ESG analysis and reporting is gaining traction in India. This includes AI and big data, that is utilization of artificial intelligence and big data analysis to assess ESG performance and risk. The next is related to blockchain. Exploration of the blockchain technology for enhancing supply chain transparency and ESG reporting. Of course, impact investing is one of the important factors where investors are seeking opportunity to generate positive social and environmental impact alongside the financial return. The next dominating factor is the financial option. This is related to the Sustainable Stock Exchange. The Bombay Stock Exchange, that is BSE, and the National Stock Exchange, that is NSE, have launched dedicated sustainability indices to promote ESG complements investings. That is to promote the ESG compliance investing. The next is related to the introduction of green bond. The Indian government has encouraged the issuance of the green bonds to finance environmentally friendly projects, attracting global investors. The green bond market in India has been growing rapidly. In 2021, India's green bond issuance reached to 6.8 billion, a significant increase from the previous year. Key trends include sovereign green bonds. The Indian government plans to issue sovereign green bonds and sustainability-linked bonds. That is, growing issuance of sustainability-linked bonds by the Indian corporates. The next is related to ESG mutual funds and disclosures. SEBI introduced a new disclosure norms for ESG mutual fund to ensure transparency and prevent greenwashing. The next is related to the growth of the ESG fund. The Indian market has witnessed a significant increase in the ESG-focused mutual fund and exchange trade fund, that is ETFs. As on 2021, there were over 10 ESG mutual fund schemes with assets under management exceeding rupees 12,000 crore. And the last one is related to the private equity and venture capital. The private equity and venture capital firms operating in India are increasingly incorporating ESG consideration into their investment process. This trend is driven by the pressure from limited partners who are demanding ESG integration. This followed by the recognizing of ESG as value creation lever and growing awareness of ESG related risk and opportunities in Indian market. Now let us see what are the challenges in ESG investing. Investing based on the environmental, social and governance principles presents several challenges despite its increasing popularity. The primary obstacle includes issues related to date, quality and reliability of the short-term market focus, limited awareness, lack of standardization, greenwashing, and the struggle to balance growth and sustainability. The first is related to the data quality and reliability. One of the foremost challenges in ESG investing is the quality and reliability of the data. ESG matrices are often self-reported by the companies and lack a standardized verification process, leading to inconsistency and potential biasness. According to a report by the CFA Institute, discrepancies in ESG data source can result in varied score for the same company, making it difficult for investors to make informed decisions. The absence of unified reporting framework further exacerbates these issues, leaving the investors to navigate a landscape of fragmented and sometimes unreliable information. The next is related to short-term market focus. The prevalent short-term focus of the market poses another significant challenge to ESG investing. Many investors and the corporate manager prioritize quarterly earning and immediate return over long-term sustainability. This short-termism is at odds with the intrinsic long-term benefits of the ESG initiatives, which often require substantial upfront investment and time to manifest in the financial performance. The pressure to deliver short-term results can deter companies from committing to robust ESG strategies as highlighted by the Harvard Business Review article on the topic, which is given in the reference. The third is related to limited awareness. Despite growing interest, there remains a significant gap in awareness and understanding of the ESG investing among both investors and the companies. Many investors lack a deep understanding of how ESG factor can impact financial performance and risk. This limited awareness can lead to underutilization of ESG data in investment decisions and lack of pressure on the companies to improve their ESG practice. A study done by the Morgan Stanley found that while interest in sustainable investing is high, knowledge and implementation lag behind. The next factor is related to lack of standardization. The lack of standardization, ESG matrices and reporting framework is a crucial barrier to the effective ESG investing. Different rating agencies uses various methodology to assess ESG performance, resulting in inconsistency rating for the same company. This inconsistency can confuse investors and undermine the credibility of the ESG rating. Efforts to develop standardized frameworks such as those by the Global Reporting Initiatives and the Sustainability Accounting Standard Board are ongoing but have yet to achieve the universal adoption. India has already adopted both the system. Next is related to greenwashing. Greenwashing, where companies exaggerate or fabricate their ESG achievement, is a growing concern in ESG investing. This deceptive practice can mislead investors and divert capital away from genuinely sustainable companies. The rise of greenwashing highlights the needs of the rigorous verification and transparency in ESG reporting. According to the European Securities and Market Authority, greenwashing can undermine the trust in ESG product and impede progress towards sustainable finance. The next and the last is related to the balancing growth and sustainability. Balancing growth and sustainability is a complex challenge for companies and investors alike. Pursuing aggressive growth often involves trade-off with the sustainability goals such as increased carbon emission or resource depletion. Investor faces difficult tasks of evaluating whether a company growth strategies are genuinely aligned with the long-term sustainability. Achieving this balance requires a nuanced understanding of both financial performance and ESG factor as discussed in the McKinsey report on the subject and listed in the reference. Overall, it seems that despite these challenges, the potential benefits of ESG investing, such as enhanced risk management, better long-term returns, and positive societal impact, are driving its continued growth. Addressing the issues of data quality, short-termism, awareness standardization, greenwashing, and balancing growth with sustainability is a crucial for the future success and the credibility of the ESG investing. In the previous slide, we have discussed about the challenges. Now we shall look about the opportunities in ESG investing in India. India presents a vast and a growing landscape for ESG investing, offering a numerous opportunities for investors who seeks both financial returns and positive impact. As the country navigates its path towards a sustainable development, several key factors are driving the potential for ESG investment. The first is related to large and the growing market. India, with its population of over 1.4 billion and rapidly expanding economy, offers a substantial market for ESG investment. The country ESG assets under management have grown significantly, reaching 12,300 crores in February 2023, up to from 2,268 crores in November 2020. For example, renewable energy, India aims to achieve 500 gigawatts of renewable energy capacity by 2030, creating a substantial investment opportunity. This growth trajectory is expected to continue as awareness increases and more investors recognize the value of sustainable investing. The next is related to the government support for sustainable development. The Indian government has demonstrated a strong commitment to sustainable development goals, creating a favorable environment for ESG investments. Initiatives like National Action Plan on Climate Change and the ambition target of achieving net zero emission by 2070 underscore this commitment. Thus, the government pushes for electric mobility is opening up investment avenue in EV manufacturing and charging infrastructure. Additionally, the Security and Exchange Board of India, that is SEBI, has mandated sustainability reporting for the top 1,000 listed companies, further promoting the ESG practice. The next is related to innovation in sustainable solution. India's vibrant startup ecosystem and the technology powers are driven innovation in sustainable solution, from renewable energy technology to sustainable agricultural practice and a clean transportation solution. There are a surge of innovative venture addressing the ESG challenges. For instance, the Indian renewable energy sector is expected to attract investment worth of 80 billion over next 4 years. The next point is related to the potential for positive impact. Given India's development challenges, ESG investment have potential to create significant positive impact. Investment in areas such as clean energy, sustainable infrastructure, education and healthcare can contribute to improved living standard and environmental protection. The International Finance Corporation estimates that the climate investment opportunities in India could reach to 3.1 trillion between 2018 to 2030. Emerging sectors and opportunities. Several sectors in India offer promising ESG investment. That is, first is renewable energy. India aims to achieve 500 gigawatt of renewable energy capacity by 2030, creating a substantial investment opportunities. The next is electric vehicle. The government pushes for electric mobility is opening up investment avenue in EV manufacturing and charging infrastructure. The next is sustainable agriculture with a focus on organic farming and precise agriculture. This sector offers a significant potential for ESG investors. Next is green building. The green building market in India is projected to double by 2022, reaching 10 billion score. Next is related to the circular economy. The investment in the waste management and the recycled technologies are gaining traction as India aims to address its waste challenges. The next is EdTech and health tech. These sectors offers opportunity to invest in solutions that improves access to education and health. Overall, it seems that the ESG investing in India is standing a crucial juncture, offering a unique blend of market opportunities and potential for positive impact. As the country strives to balance economic growth with the sustainable development, ESG investment can play a pivotal role in shaping a more sustainable and inclusive future. For investors willing to navigate the complexity of Indian market, the ESG sector offers promising prospect for long-term value creation and societal benefits. Now, since we have discussed the challenges and opportunity of investing in India, let us discuss in detail the future outlook of ESG investing in India. ESG investing is gaining significant momentum in India. The future outlook of ESG investing in the country look promising, driven by regulatory advancement, growing investors' maturity, enhanced ESG integration, collaborative initiative, and technological advancements. These factors collectively indicate a robust trajectory for sustainable investment in India. Let us look one by one. The first is related to the regulatory advancement. Regulatory advancement are poised to play a pivot role in shaping the future of ESG investing in India. The Security and Exchange Board of India, SEBI, has been proactive in introducing regulations that mandate ESG disclosure for the top 1,000 listed companies by marketing capitalism. This move towards a greater transparency, ensuring that investors have access to essential ESG related information, fostering a more informed investment environment. Additionally, the Ministry of Corporate Affairs is working on guidelines for social stock exchange, which will allow social enterprises to raise funds through the capital market, further promoting ESG-focused investment. These regulatory measures create a conducive environment for sustainable investment, encouraging more companies to adopt ESG principles. The next is related to investor maturity. The maturity of investors regarding the ESG investing is growing steadily in India. Institutional investors, asset managers, and retail investors are increasingly recognizing the long-term benefits and incorporating ESG criteria into their investment decision. This shift in perspective is driven by a growing body of evidence that suggests ESG compliance companies tend to perform better financial and are more resilient to market volatility. According to the report of Morgan Stanley, sustainable investments have shown to provide strong returns and lower risk over time. As investors becomes more knowledgeable and sophisticated, the demand of ESG compliant investment option is expected to rise, further fueling the growth of sustainable investing in India. Next is related to enhanced ESG integration. The companies in India are increasingly integrating ESG factor into their core business strategies. This enhanced integration goes beyond mere compliance, as a business recognizes that the sustainable practice can lead to improved operational efficiency, risk management, and long-term profitability. According to a study by the International Finance Corporation (IFC), firms that adopt ESG principles are better positioned to attract investment and enhance their corporate reputation. As more companies incorporate ESG consideration into their decision-making process, the overall market of ESG investment is likely to expand, providing investors with a broader array of sustainable investment opportunities. The next is related to the collaborative initiatives. The collaborative initiative between the public and the private sector, as well as international partnership, are crucial for advancement of ESG investing in India. Public-private partnerships such as Indian Climate Collaborative are instrumental in mobilizing resources and expertise to address climate change and promote sustainable development. Additionally, international collaboration with organizations like the United Nations Principle for Responsible Investment, that is UNPRI, are helping to align Indians' ESG practice with the global standards. These collaborative efforts enhance the credibility and impact of the ESG investment, driving further growth in the sector. So next is related to the technological advancement. The technological advancements are playing a transformative role in the ESG landscape. Innovative in a big data, artificial intelligence, that is AI, and blockchain are enabling more accurate and efficient ESG data collection, analysis, and reporting. For instance, AI-driven analytics can help identify ESG risks and opportunities, while blockchain technology ensures the transparency and traceability of the ESG-related information. According to a report by the World Economic Forum, technology is pivotal in advancing sustainable finance by enhancing data quality and reliability. As technology continues to evolve, it will provide investors with better tools to access ESG performance and make more informed investment decisions. Continuing from my previous slide, let us look further upon the outlook for ESG investing in India with more dominating factors such as standardization of ESG reporting. One of the key developments shaping the future of ESG investing in India is the standardization of ESG reporting. The Security and Exchange Board of India, that is SEBI, has mandated the top 1000 listed companies to disclose their ESG performance. This move aims to enhance the transparency and provide a uniform framework for ESG reporting. Standardization reporting enables investors to make more informed decisions by ensuring that ESG data is consistent, comparable, and reliable. The Global Reporting Initiative and Sustainability Accounting Standards Board framework are being increasingly adopted by the Indian companies to align their reporting practice with the global standard. This shift towards the standardization ESG reporting is crucial for building investors' confidence and facilitating the growth of ESG investing in India. The next factor is promoting sustainable finance product. The promotion of the sustainable finance product is another significant driver for the future of the ESG investing in India. Green bonds, social bonds, and sustainability-linked loans are gaining traction as visible investment option. The Reserve Bank of India has introduced guidelines to encourage banks to finance green projects, further supporting the growth of sustainable finance. According to the report by Climate Bonds Initiative, India has emerged as one of the largest markets for the green bonds in Asia. These innovative financially products not only provide the investors with the opportunity to invest in sustainable projects but also help in channeling capital towards initiatives that contributes to environment and social goals. The next is related to the sectoral growth. Certain sectors in India are poised for the significant growth driven by the ESG factors. Renewable energy, waste management, water conservation, and sustainable agriculture are some of the key sectors attracting ESG investments. The Indian government ambitious target to renewable ESG capital capacity as outlined in the National Solar Mission and other initiatives present lucrative opportunities for investors. Additionally, the waste management sector is seeing increased investment as cities and industries look for sustainable way to handle waste. As these sectors continue to grow, they will play a crucial role in advancing the ESG investing in India. The next factor is related to the focus on the social sector, most important one and largely neglected also. The social aspect of the ESG is gaining increasing attention in India. Investment aimed at improving the social outcomes such as healthcare, education, and affordable housing are becoming more prominent. The COVID-19 pandemic has underscored the importance of social investments in building resilient community. Social impact bonds and other innovative finance mechanisms are being explored to address the social change. According to a report by the International Finance Corporation (IFC), investment in social sector can yield significant return while driving positive social change. This growing focus on the social dimension of ESG is crucial for holistic, sustainable development. Last but not the least is the engagement and the stewardship. Enhanced engagement and the stewardship by the institutional investors are set to play a pivotal role in the future of ESG investing in India. Investors are increasingly recognizing the importance of active ownership and engaging with the companies to drive ESG improvement. The principle of responsible investment, that is PRI framework, encourages the investors to incorporate ESG consideration into their ownership, policies and practice. By engaging with companies on ESG issue, investors can influence corporate behavior and promote sustainable business practices. This proactive approach to stewardship not only benefits the investors by reducing the ESG risk but also contributes to broader societal and environmental goals. Overall, these factors collectively create a supportive ecosystem for sustainable investment, positioning India as a key player in the global ESG landscape. As the momentum of ESG investing continues to build, it offers a promising pathway for achieving the sustainable development and long-term financial growth. Now let us explore what are the major factors for investing in India. First is related to ESG rating and indices. We will take one by one each factor. The ESG rating are crucial for investors seeking to evaluate a company's sustainable and ethical impact. In India, the demand for high quality ESG data has led to significant advancement in rating methodologies. Major rating agencies like MSCL, Sustainability and local agencies such as SEBI approved CRISIL are providing comprehensive ESG assessment for the Indian companies. These ratings help investors identify companies that excel in managing environmental risk, social responsibility, and governance practice. According to MSCI, companies with a high ESG rating often demonstrate superior risk management and long-term financial performance, making them attractive and investment option. The second is related to ESG indices. The creation of the ESG indices in India further supports sustainable investing. The NSE Nifty ESG 100 Index and S&P BSE 100 ESG Index are notable examples that track the performance of the companies with robust ESG practice. These indices offers a benchmark for investors looking to incorporate ESG criteria into their portfolio. By investing in these indices, investors can gain exposure to companies that are not only financially sound but are also committed to sustainability. As per National Stock Exchange, India, these indices are designed to include companies that meet stringent ESG criteria, ensuring that investor funds contribute to sustainable growth. The next is related to global alignment. Most important, India's commitment to aligning with the global ESG standard is a major factor attracting the international investors. Initiatives such as the adoption of the Global Reporting Initiative, that is GRI, and the Sustainability Accounting Standards Board, that is SASB, framework ensured that the Indian companies adhere to internationally recognized ESG reporting standard. Additionally, the Security and Exchange Board of India, SEBI, mandate ESG disclosure for the top 1,000 listed company, promoting transparency and accountability. According to the GRI, this alignment with the global standard enhances the credibility of Indian companies in eyes of global investors, making India a favorable destination of ESG investment. Now we shall look the inclusionary investing. Inclusionary investing has emerged as a pivotal strategy for investors looking to capitalize on the robust growth potential of India. As the world's fifth largest economy, India offers a diversified and dynamic investment landscape. This approach, which emphasizes investment in companies and sectors that promote social and environmental sustainability, is gaining traction among global and domestic investors alike. Let us see first factor, that is India's rank high. India ranks high on several global indices for sustainable and inclusive growth. According to MSCI Emerging Market Index, India is one of the top performers due to its commitment and environmental, social, and governance criteria. The country's regulatory framework has also been supportive with the Security Exchange Board of India mandating the top 1000 listed companies to provide business responsibility and sustainability report, that is BRSR report, which ensure transparency and accountability in the corporate practice. The next is related to selecting the right investment in India involves a thorough analysis of companies' adherence to inclusionary principles. Key sectors that stands out include renewable energy, healthcare, education, and financial services. Renewable energy sector in particular has seen substantial growth, with India aiming to achieve 175 gigawatt of renewable energy capacity by 2022, which is already been done. Investments in this sector not only promises attractive return but also contribute to country's climate goal. The next is related to the benefits of inclusionary investing in India are manifolds. Investors can achieve strong financial returns while making positive social impact. Companies that prioritize ESG factor tends to perform better in a long run as they are more resilient to regulatory changes and reputational risk. Additionally, inclusionary investing helps in mitigating risks associated with environmental degradation and social inequality, fostering a more stable and sustainable economy. In conclusion, inclusionary investing in India presents a compelling opportunity for investors. By aligning their portfolio with sustainable and inclusive growth, investors can contribute to India's development while securing long-term financial gain. As the country continues to advance its ESG initiative, the potential for inclusionary investment is set to rise, making it crucial consideration for any forward-thinking investors. By focusing on inclusionary investing, investors can not only drive positive change but also reap the benefits of India's vibrant growing market. Now we shall propagate the responsible investment policies in this regard. Let us see. The first is related to the integrating ESG factors. Developing a responsible investment policy is essential for organizations committed to sustainable growth and ethical investing. These policies should outline the organization approach to integrate environmental, social, and governance factors into investment decision, ensuring aligning with the long-term sustainable goal. The policy must define the scope and objective, emphasizing the importance of ESG criteria in enhancing the investment performance and mitigating risk. It should detail the process of ESG integration, including the identification, assessment, and monitoring of the ESG risks and opportunities, and one must understand that the policy should incorporate a continuous improvement framework, encourage periodic review and update to adapt to evolving ESG standards and practices. This proactive approach ensures that the organization remain at the forefront of the responsible investment trends. The next is related to implementing responsible investment policy. Implementing a responsible investment policy involves integrating ESG factors throughout the investment process, from due diligence to portfolio construction and monitoring. During due diligence, investment teams should systematically assess the potential investments against the ESG criteria, identify risks and opportunities related to environment, impact, social responsibility, and the governance practices. This thorough analysis ensures that investment aligns with the organization values and sustainability goals. In portfolio construction, ESG considerations should influence asset allocation and selection. This involves prioritizing investment in companies with a strong ESG performance and divesting from those that pose significant ESG risk. Incorporating ESG score and matrices can help in constructing a diversified and risk-silent portfolio. Further, the monitoring is crucial to maintain the integrity of the responsible investment. Regular reviewing ESG performance and engaging with the invitees companies on their ESG practice ensure continuous alignment with the policy. This proactive monitoring helps in identifying emerging risks and opportunity, enabling timely adjustment to the portfolio. Overall, integrating the responsible investment policy into all stages of investment process promotes long-term sustainability and ethical investing, ultimately enhancing the financial performance and societal impact. The next point is related to engaging and collaborating for responsible investment. Engaging and collaborating with the company's policymakers and other stakeholders is essential for promoting sustainable practice and advancing responsible investment initiatives. Investors play a key role in encouraging companies to adopt better ESG practice. Through active dialogue, they can influence corporate behavior by advocating for transparency, ethical governance, and sustainable operation. This may involve voting on ESG-related shareholders' resolution, participating in annual general meeting, and engaging in regular discussion with the company's management. Collaborating with the policymakers is crucial for shaping a regulatory environment that supports sustainability. Investors can provide valuable insight and feedback on proposed regulation, ensuring that policies encourages responsible investment and corporate accountability. Engagement with other stakeholders such as industry association, non-governmental organization, and academic institution foster knowledge sharing and development of the best practices. These collaboration can drive innovation in ESG strategy, amplify impact, and promote a collective approach to addressing global sustainability challenges. Overall, proactive engagement and collaboration help build a more sustainable and resilient investment landscape, benefiting both investors and society. The last factor is related to reporting and disclosure for responsible investment, which is the most important one. Transparent reporting and disclosure are vital components for implementing a responsible investment policy. Regular communicating ESG performance and progress ensures accountability and build trust with the stakeholder. Organizations should produce comprehensive ESG reporting detailing how responsible investment policies are integrated into their investment process. These reports should include matrices on environmental impact, social responsibility, and the governance practice, highlighting both achievements and areas for improvement. Disclosing a relevant ESG information to stakeholders such as investors, clients, regulators, and the public demonstrates commitment to sustainability and ethical investing. This can be done through annual report, dedicated sustainability report, and regular updates on the company's website. Additionally, aligning disclosure with recognized framework like Global Reporting Initiative, that is GRI, or the Task Force on the Climate Related Financial Disclosure, that is TCFD, enhance the credibility and comparability. Transparent reporting not only fosters the stakeholders' confidence but also drives continuous improvement by enabling organizations to benchmark their ESG performance against the industry's standards. Well, this is my last slide for this presentation, and wrapping up this presentation, let's recap our journey through investing in ESG for India. We delved into the UN principle of responsible investment and accordingly decoded the BRSR updates. We have explored the surge in ESG investment in India, tackled the challenges, and uncovered the opportunities. We have also projected the future outlook for ESG investing in India, emphasizing importance of keeping an eye on the global ESG rating and indices before making investment. In conclusion, we advocate for responsible investment policies and now pose the question: is sustainability the future of investment? So stay tuned for the next week for exciting topic on explore sustainability investment strategies for India. Until then, my best wishes to all of you and stay safe.